investing. So I thought I would make this video as a sort of crash course on investing, talk about why you should invest, sort of how to get a basic understanding of how the stock market works, the mechanics behind it, and talk about a simple strategy that outperforms 80 to 90% of actively managed funds, aka the pros. And then finally talk about what are some ways in which we can even do better than this simple strategy that I mentioned. So if nothing else, you'll take away this strategy for, basically outperforming most people who invest. And we'll talk about how to get a better understanding. So without further ado, let's get into it. So why should you invest? Well, for me, I wanted to invest because I wanted to do this, and I still do, this AI research on Parkinson's and Alzheimer's with my AI technology. And I realized I needed more capital in order to build these technologies that I wanted to build. So I started looking into stock market investing. And then I realized, I want to be able to escape from having to do a 9 to 5 and run my own business. I want to be able to take care of my family and, especially thinking about having children in the future, be able to provide for them. So there's many great reasons to invest. I think we all want to make more money and be able to take care of our family and all this sort of thing. Another reason is, well, the dollar is depreciating in value over time, right? A gallon of milk back in 1930s was a lot cheaper than a gallon of milk today, or the price at least was a lot lower than the prices today. So the value of the dollar is going down over time. So a lot of people talk about the risk of investing, and there is an inherent risk in investing, something we should always be aware of. There's no guarantees, right? But for sure, there is an almost certainty that the money sitting in the bank account is going to be losing value over time, just sitting there, not doing anything. We want to put our money to work, so we want to invest. So let's get into it. So what's the simple strategy for beating most actively managed funds? About 80 to 90%. And I should note that there is research to show this. I won't get into the exact reasons as to why, but this very simple strategy is doing something like buying an ETF. So a classic example is SPY, SPY. So with SPY, you're getting a tiny piece of every company within the S&P 500. The S&P 500 tracks the top 500 companies in the US based on their market cap. So these are companies like Apple, Verizon, Microsoft, Walmart, Tesla, etc., right? We're getting a tiny piece of each one of these. And on average, over the last 90 years, the S&P 500 has increased returned 10% on that investment every year over the last 90 years. Now, some years it was down 20%, some years it was up 20%, but on average, we have done a 10% return over the last 90 years, which is great considering all you're doing is just buying this one ETF. Really no thinking, you kind of just turn your brain off and then just buy this one ETF. Highly recommend this strategy. Well, okay, let me take that back. This is educational only. I'm not a professional advisor or anything like that. So I'm just saying, this is a good strategy if you want to invest. Think about an ETF. Another example would be the Vanguard Total Index. With that, you're actually getting just a sort of a nano piece of every business in the US market. So you're getting an even broader exposure to the market. I think it's done approximately what the S&P 500 has done over the last 90 years. Don't quote me on that, but two very good options to consider. There's a whole field of ETFs to look at, but those are two to consider if, you really don't want to delve too deep into the stock market, but you want to have a good return. You're doubling your money roughly every 7 years by doing something like this, right? Again, no guarantees. Past performance doesn't guarantee future performance, so just keep that in mind, right? But what if you want to understand more about the stock market and think, well, 10% per year is actually really great, but what if I want to do even better than that? Well, I think it's important to understand really why does a company issue shares in the first place, right? Effectively, they issue shares because they're trying to raise money. It's a fundraising thing. So, for example, maybe a company wants to buy some new equipment Like they want to build a new factory so that they can make more electric vehicles, but they don't have the capital to do that. So they issue shares, people buy the shares, they get the money from the shares sold, and then they're able to build the factory, make more cars, sell the cars, more profit. Bam, perfect, right? So that's the whole reason that companies offer their shares. And I apologize if you guys know this already, but when the shares are bought, it's a supply and demand sort of thing, right? The more shares that people buy, the more the price of the shares goes up. The more people sell off their shares, the more the price of the stock goes down. So classic supply and demand at work. Those are sort of the basic mechanics here, right? So knowing this, right, how do we figure out what stocks to buy? Well, I would advocate we look at trying to figure out what the intrinsic value of the business is, right? A lot of people, how do they buy stocks? They read about it in the news, they get a tip from a friend, they see the stocks just shooting off to the moon, and they're like, it's sort of a FOMO thing. They don't want to miss out on this huge rocket ship going to the moon, so they buy that share, they follow the momentum. But I would advocate against this on the basis that we don't really know what the business is worth. We're just sort of following the herd. But, businesses are not tickers, moving up and down randomly on a chart. When we're buying shares of a company, we're becoming a partial owner of a company. And as an owner of a business, what do we want to see, right? We want to see profit. We want to see earnings. We want to see that the revenues are growing year over year. We want to see that the cash flows are growing year over year. So we want to see that they're continuing to innovate, that they're putting that money back into research and development to make more products, right? So there's a real tangible business that's tied to those shares that we're buying. So when we're buying the shares, before we buy the shares, we want to understand the business as best we can. Understand and see, look at, are they growing their revenue year over year? Are they growing their earnings, their cash flow? Are they putting money back into research and development, coming out with new products? And really what we want to be thinking about is we want to buy stuff that's on sale, right? Or at least based on how we've valued the business, is the price that's being offered cheaper than what we think the value of the business is? So to do that, we have to come up with this intrinsic value. Now, of course, coming up with that intrinsic value is a lot more difficult, or it's more complex than what we've talked about thus far. But it's some simple math to do it, and we can talk about that in a future video. But just to return back to the start here, we talked about when their companies are issuing shares, right? They're looking to raise capital. Well, what are they doing with that capital? They're investing it back into the business to, let's say, maybe they're buying ice cream machines so that they can sell more ice cream, right? How much are they getting back from that ice cream, right? If they had bought an ice cream machine for $100, let's say, and they made $30 in ice cream, there's a 30% return right there. So we want to look at the return on invested capital. I'll talk more about the exact formula for how to do that. But you can see there's some really simple ideas at play here. And that's, we want to buy good businesses that are selling below their intrinsic value, Again, we'll talk more about ways in which to figure out that intrinsic value, but just very simply speaking, there's some clear signs we can look at. Are they growing their revenue year over year, their earnings, their free cash flow? Are they potentially buying back shares of the business so that when there's less outstanding shares in the market, the value of each share is more, right? Are they putting more money into research and development so that they continue to innovate and become sort of market leaders, if there were? Are insiders in the company, the CFO, the CTO, the president, are they buying shares in the company as well? That's a really powerful sign to look at. So these are all some things to kind of get the ball moving and just get you thinking about, buying stocks, buying shares of a business based on that underlying business itself and what it's intrinsically worth versus just seeing something that's really popular that everyone's crazy about and then just sort of following the bandwagon. Leave you with one piece of advice, and that's, be greedy when others are fearful and be fearful when others are greedy. I believe Warren Buffett was the one to first say that. But just to give you an example of what I mean by that, back in March, mid-March, the S&P 500 was down about 40%, right? Which is really, really steep decline. But by the end of 2020, the S&P 500 was up 16%, which is a really great return. So imagine if you had bought when others were fearful at that very low point in March, you would be looking at a 56% return. If you had hit it at that lowest point and bought when people were most fearful, and 56% return is massive, massive return. If you were able to do that year over year, your wealth would go crazy. So that's a final piece of advice to consider. Again, I'll want to talk more about how to do intrinsic valuations in future videos, but hopefully you got something out of this video. If nothing else, a simple strategy to get started with investing. Hopefully there's something valuable in here. If you liked the video, let me know. And if you have investment questions, leave them in the comments below, and I'll see you very soon.